The order today is such that Taneli will start off with his presentation, and after that Jan will follow the act, and we will reserve abundant time for your questions and a good debate and discussion for the end part of the session today. So without further ado, many thanks, gentlemen, for coming, and Taneli, floor is yours.
Thank you very much, Harry, and thank you also, Jan, for being ready to discuss these issues that we have in fact and discussed with him at several occasions over the past few years. And the tradition usually is that we come up with an idea and we try to make it happen, and then Jan is the one who criticizes and sort of tears it apart and tells us why it will not work. And it's a very good dynamism, and it has also helped us improve and develop our ideas a lot. It's good to see that there are so many that there's so much interest in this issue of economic governance in the Economic and Monetary Union. I hope that it's not only because Harry has forced or obliged you to be here. I hope that in the next hour and a half you will also demonstrate that you actually want to discuss this and you because you have a big stake in all of this. I thought that I'll begin by telling a little bit about where we've come from and what we have done over the past 3 or 4 years to strengthen the fundamentals of the Economic and Monetary Union, and then I'll try to give a bit of an outline about where we believe we are at the moment in terms of overcoming the crisis and getting back on feet again. And then perhaps if you're interested, we could discuss perhaps then later on what should come next, how far should we actually go. And I'd like to start by claiming that over the past 3 or 4 years we have actually taken quantum leaps in terms of effective practical integration of the Economic and Monetary Union. This is something that Jean-Claude Trichet, who back then was president of the European Central Bank, at the deepest moment of the crisis, he said that the central bank will do what a central bank will have to do, but first the governments will have to show, and the European institutions will have to show that they are ready to take quantum leaps in terms of fiscal and economic policy integration. We believe that this is what we have managed to do within the limits of the current treaties. And in fact, if we want to move further than this, then we need to go into real deep fundamental considerations about how far it is that European people, European citizens are ready to go in terms of further integration. But let me start by telling a bit of a story of how we started. And we came, or this commission, this college took office in February 2010, and that was at the time when the economy was deep in a crisis. The fiscal deficits in all member states were skyrocketing. The Greek crisis was unfolding. Greece had, in fact, already lost market access for financing its public services, its public finances, and we had to very quickly, immediately, try to do 2 impossible things at the same time. First one was that we had to. The first one was that we had to find ways to actually contain the crisis, find mechanisms to help Greece continue still holding as a society, because a default of a government, especially at the moment like the one we had in 2010, would have meant a complete collapse of the society, all its public services and everything that will follow, and that would probably not have stopped in Greece, and it would have then continued further. So we had to find means quickly to stop that and to find ways to finance the Greek government. We did that by establishing first what is called a Greek loan facility, which a week after the decision was clearly not sufficient. The markets were not happy with that decision yet. We had to immediately then also come up with a bigger solution that is available for all euro area member states, that was called the EFSF, the European Financial Stability, I can't remember the fund, perhaps? Facility, yes, thanks Jan. Which then was turned later into the European Stability Mechanism, that is now a fiscal backstop of, depending on how you want to count it, 500 billion or 750 billion euros, which makes it the largest fiscal backstop in the world. It is far bigger than the IMF has ever been or will ever be. But that was one thing. I mean, we had to find ways to contain the immediate crisis. But at the same time, of course, and we had to reflect how it had been possible that the euro area entered a crisis like that. And there were 2-3 things that we found, or that we realized very quickly. First one was that well, Greece had cheated on its public finance statistics. We wondered, how is that possible? And we looked at the experience of the past few years, and it came out that the Commission had twice per year, for several years in a row, the Commission had warned member states that the statistics in Greece were not reliable. But the member states did not want to listen. They did not want to hear that. The Commission had suggested already, I think in 2005, that the powers of Eurostat, the statistical authority of the European Union, that those powers would be increased so that Eurostat would actually be able to check and verify that the statistical data that is submitted to us by member states. But the member states did not want to hear it. They did not want to give Eurostat the powers to actually check what they are being told by the national statistical authorities. Second thing was that we found out that the Commission had for several years in a row warned the other member states and Greece that the public finances of Greece were not on a sustainable path, and we had also warned that there were severe macroeconomic imbalances building up in Greece, that this all was a dangerous development. But again, member states did not want to listen, and we did not have the means to actually do anything about it, except to issue or to issue analyses and reports. Third thing that we found out was that right at the and this was in fact a demonstration of how the original structures were flawed. In fact, and they were not even meant to function. When we started in spring 2010. One of our first jobs, regular tasks to do, was to assess member states' fiscal and structural policies for 2010, which we of course did, and then we arrived at some conclusions in June, July 2010. But of course, if we give an assessment and some recommendations about policies for 2010 in the middle of the year, that's not going to have any impact at all. That's not even meant to have an impact. That is just just nice to know, but that's all. And so, what did we do? And we were relative newcomers to this job. And Mr. Rehn had done enlargement policies before, and we did not have all this burden of knowing what all is impossible, you know. So we thought that, well, let's try to make this more simple. Let's try to. First of all, well, we managed to get the additional powers to Eurostat so that now actually they can check that the data that they receive from member states is actually correct. Second, we introduced what is called the European semester. How many of you have heard about, by the way, about the European semester? 1, 2, 3, good, thank you. So it's not all in vain, I see. And we introduced the European semester, which is a policy coordination process at European level, which takes place before national decisions are taken. And we started using this, or applying this European semester right from the beginning of 2011. And that meant that in the first half of the year 2011, we assessed member states' policy plans for 2012. And then in the summer 2011, we arrived at some recommendations and conclusions and guidance to member states about what we thought the member states should be doing in 2012, both in terms of their fiscal but also broader economic policies. And these Commission recommendations were then turned into Council recommendations, which makes them, of course, much more legitimate and more binding than just the Commission. That's just the Commission expressing its view. So, with this European semester, and we streamlined the various policy coordination mechanisms, we front-loaded them time-wise, and we created a mechanism that, at least in theory, can have an impact on the policy choices that a member state will actually do. And then third, we also introduced a whole package of new legislation that was supposed to, and that is, in fact, having an important impact in the sense that it makes it more certain that the rules of the treaties and of the Stability and Growth Pact are actually implemented and that they can be enforced. And hereby I mean that, well, some of you may have heard about the Stability and Growth Pact, which basically sets the rule that no member state should be running public deficits higher than 3% of their GDP, and nobody should have have higher public debt than 60% of their GDP. When we started in 2010, out of the 27 member states back then, I think 24 were breaking the rules. And we thought that, well, there's nothing wrong with the rule as such, but it was just that member states were not actually complying with it. So we thought that, well, maybe we need to introduce mechanisms, instruments, legislation, enforcement mechanisms that will make these rules more binding. After all, I mean, these are rules that the member states have set on themselves. And it is for us, for the Commission, to make sure that the member states stick to their commitments. So we introduced a mechanism whereby we follow and monitor the fiscal developments in a member state very closely, and in case a member state does not comply with the recommendations that it receives, it will eventually face sanctions, financial sanctions, up to 0.2% of GDP, which doesn't sound very much, but I can tell you that when the paper is on the table where the sum is written down and is presented to the government who's supposed to follow the recommendation, it does help the discussion. And we've done that at a couple of occasions, but we never had yet to actually apply a financial sanction. On top of this, we also broadened a little bit the scope of economic policy coordination, from the purely fiscal, that has to do only with public finances, to the more structural issues. Because we saw that, for example, in Spain, Portugal, Ireland, the problems were not so much yet on the fiscal side, on the side of public finances, but they had been building up macroeconomic imbalances, mostly property bubbles and over-indebtedness of the private sector. That was visible already in advance, but nobody did anything about it. And we thought that there will have to be a mechanism whereby we monitor these kind of developments more strictly, and we should have also mechanisms that allow us to intervene before it is too late, before these macroeconomic imbalances develop into something that actually becomes very costly to the whole society and also to the euro area as a whole. Some of you may read economics and will know what macroeconomic imbalances are, but in their most sort of concrete terms, a housing bubble is a macroeconomic imbalance. When there's a housing bubble, meaning that the prices of property, of apartments and houses are increasing very fast, everybody usually inside the bubble enjoys it. Because as long as the bubble keeps growing, everybody's happy. The ones who own houses, the banks who are giving mortgages to those houses because they can sell more debt, and also the government, which usually also benefits from the tax revenue that it gets from an increasing housing bubble. So nobody inside the bubble will want to see it. Even if they saw it, they do not want to recognize it. It is only from the outside that you can actually notice and point to an imbalance before it becomes too big. And this is why we introduced what is called a macroeconomic imbalances procedure. A horrible title, but I can tell you it's an effective tool. So we did these three things: statistics, right timing and streamlining of policy coordination mechanisms, and then more binding rules and instruments for actually better making sure that member states stick to their commitments that they've taken themselves. In addition to this, we also then later on in 2011 we proposed two more additional pieces of legislation that have to do with the euro area only. And this goes with the name of the two-pack. And this is something that will probably be also in the press and headlines this autumn. Jan may know more about that, but I suspect that it is something that will draw the attention of the public in many member states, because with the two-pack, it has two parts, of course. One part has to do with actually bringing into the community framework the intergovernmental support mechanisms for governments that I just mentioned, and the ESM and all of that. That's one thing. But the thing or the part of the two-pack that will make the headlines this autumn has to do with budgetary surveillance again. And here's something that is a complete novelty, and that probably will test the limits of tolerance of European citizens once we start applying it. Because we have now a rule that euro area member states will have to submit to the Commission by the 15th of October, that's next week, their budgetary plans for next year. We will then assess those budgetary plans, and we will issue opinions on those plans by mid-November. And it doesn't sound perhaps too dramatic, but it is the first time that we are actually doing something like this. And the Commission, a European institution, is giving an opinion on the national budget plan before it is adopted at the national level. And this means that there is a certain implied seniority of the European policy coordination above the budgetary sovereignty of a member state. And with this opinion, I mean, it is just an opinion, of course. And we do not have the powers to veto a budget. We don't have the powers to actually suggest detailed changes to any budget. And this the treaties wouldn't allow us to do. And I think also politically and democratically it would not be the right thing to do for us, at least yet. But it will still be very powerful, because by issuing an opinion that will be public, also the markets will read that opinion quite clearly. And I would imagine that also opposition representatives in national parliaments will read that quite with some interest, or at least they should. And so it is going to have an impact, because the markets will react, and if we issue a very critical opinion, there will be questions, and a government will probably have to take that opinion into account in finalizing its budget proposal and in finalizing the whole budget. We also have the possibility of actually asking a member state to submit to us a new plan if we think that the first plan is not in line with the European level recommendations and commitments taken by a member state. But that will be a big step. I frankly think that we are not going to do that now this time around. And I also don't really see, and having a bit of an idea about what member states are planning to put in their budget plans, I don't think that there will be so big discrepancies that we would actually have a need to ask for a new budget plan from anybody. But nevertheless, I mean, this is going to be a big issue, because once we issue the first opinions, I'm quite sure that the following day there will be questions from various parts of Europe asking that, why is this your business? Why does this matter? Who are you, Commission, to tell us what we are supposed to do with our budgetary sovereignty? Thing is that the budgetary sovereignty is of course there, yes, but in effect, member states of the European Union have since the beginning of the Union, and since the treaties have been there, and they have already agreed that their economic policies, including their budgetary policies, are not anymore only their own matter, but they are a common concern. And there's an obligation in the treaties which says that the member states have to coordinate their economic policies in the Council. Because there's no member state can actually run economic policies without having an impact on its partners in the Union, and especially in the Eurozone. Nobody can sort of assume that they can run economic and fiscal policies without actually having an impact on the others. So it is a common concern, and these policies have to be coordinated at European level. And this is what we are now doing with the full force of the treaties for the first time this autumn. And we have been criticized for being too strict and for being too discipline-oriented and for being too tough with budgetary policies in particular. Now, yes, I think we have put quite a lot of emphasis on discipline. Discipline meaning here that it is our job to make sure that member states actually stick to the treaties and to the legislation that they have agreed and that they have taken on themselves. So yes, we are looking after that. And this is not only because we are obsessed with petty legislation, but it is because it has a good purpose. Most of our member states are running still very high public deficits, and they have a very high public debt burden. Those deficits and that debt will have to be financed by private investors mostly. Those private investors do not finance those deficits or that debt unless they are sufficiently convinced that they will be paid back. And that is why they pay a lot of attention to actually these fiscal rules being strictly applied. Second thing is that there's some discussion now about whether the fiscal stance and the fiscal policies have been too austerity driven, which is, by the way, a word we have never used and we will never use, and we have never run any austerity policies, but we do care about the sustainability of public finances and their sustainability. But 3 years ago, and when we started in 2010, the euro area aggregate deficit was close to 7% of GDP. And member states were quickly losing access to anybody and who would finance those deficits. The debt levels were already at 85, 86% of GDP. This year we are going to be above 90%. Next year we might be stabilizing the debt levels, but then thereafter, with some luck, we might be actually getting into reducing those debt levels. But back then, there was no luxury of actually trying to choose a slightly smoother path of consolidation, because there was just no money around to finance any smoother path of consolidation. With the new rules, with the market pressure, and with the coordination of policies at European level, we have actually made quite some good progress in terms of stabilizing the situation with public finances. And now this year, the euro area will be pretty close to 3% of GDP, meaning that collectively everybody is now soon close to actually applying the rules that I again want to stress they have put on themselves. Not us, but the member states in the treaties. And the debt levels are still extremely, well, not extremely high, but say very high, and they will have to be brought down because the debt levels, they eat very much into the possibilities of governments, but also individuals, the private sector, to invest into something more productive than just debt service. For example, investment into universities, or roads, or new industry and new jobs. If your debt is at around 100% of GDP, your you have to pay 4 or 5% interest rates for your debt per year. That means typically that around a third or a fourth of all government revenue goes into just paying the interest rates. And that doesn't make in our view, much sense. Which is why we continue to think that the consolidation of public finances and reduction of the public debt levels is extremely important for Europe, for the euro area, for the longer term. It is because of growth and jobs that is necessary, not because of our obsession. But this, of course, I mean, the public finances alone will not do the trick. At the same time, member states will actually have to do the structural reforms that are long pending, long due, that will actually allow a more efficient allocation of resources, of scarce resources, capital, labor, all of that, so that our economies can be competitive and create growth and jobs. And of course, the competitiveness challenge to the euro area is increasing every day. And the engine for our growth and competitiveness is the single market of 500 million people. And in order to make that function, there will have to be reforms at European level to complete the single market, but also each and every member state will need to make sure that their economic structures are such that they can actually let entrepreneurship flourish. And also there, we see that in many member states, almost in all member states, there is now what Vice President Rehn likes to call a wave of reforms ongoing. It is maybe not yet fully recognized by everybody, also by the investors, but it is there. Also in countries like France, like Belgium, also Germany, Italy, Spain, and where we know that there have been long pending reforms on the labor market, in the pension system, in the product and services markets, and that have been impossible politically to implement for years, if not decades. Now things are happening, things are moving forward. And this is where I come to the economic outlook at the moment. All these efforts are now slowly starting to bear some fruit. The economic situation has more or less stabilized this summer, meaning that the economy is not contracting anymore. The investors have become more confident about the perspectives of the economic and monetary union and about the European economy in general, and they have, and so that means that the interest rate levels have come down a little bit. We believe that if governments, member states continue pursuing the policies that have been jointly agreed, we will see next year a recovery and return to growth at the European Union and euro area level. Not in every member state yet necessarily, but in the euro area as a whole. That will not immediately yet bring along an improvement in the employment situation, which is dramatic, but it will start having a positive impact also in employment, say in the second half of next year, because employment usually always reacts with a time lag of half a year or a year to economic growth. So we believe that the job is not at all done, and there's still a lot to be completed, especially on the banking union side, and where you know that is perhaps the third element of the reform of the economic and monetary union after the strengthening of fiscal coordination and strengthening of coordination of economic policies. Now we are finalizing and working on the banking union, which simply means that since banks operate, or there are 100, 150, 200 banks that are very large and that operate in Europe, not in a single member state, but in Europe or several member states at the same time, these banks also need to be supervised at European level. And in case those banks get into trouble, then also their resolution needs to be European. But this again means that member states are asked to actually give to the European level powers and competencies that they've long considered to be their own and their own only. And now it is about actually recognizing that some of these powers need to move to the European level, so that the costs to the taxpayers can be minimized. In fact, that's That's what it is essentially about. But with these elements, we are coming close to what can be done in terms of deepening the economic and monetary union within the current treaties. And then the question follows what we will do thereafter. What is still necessary after all of this, and what are European citizens actually ready to accept and ready to move towards. Maybe I'll stop here and then listen to Jan tear this all apart, and then you guys.
And we'll start again. Very good. Thanks very much, Taneli. So, I think it's at least a clear presentation to tear apart. So let's hear from Jan.
Well, thank you very much. And
do you have your presentation, by the way, up running, or?
It's okay. I mean,
I didn't use them either, so
I noticed. You will get the slides anyway after that. We have them here on the computer. So
actually, I mean, you've listened to one of the best experts on the subject available, and he's also clearly a good public speaker because he didn't even use any notes. He just keeping eye contact with you all the time and speaking. So I'm not as good as that. I'm a journalist, which means I normally sit where you sit, listen to people like him, and ask annoying questions. So it's so you'll have to excuse me that I will actually from time to look to my notes. But just to begin, I'm sure you all know the Chinese curse, which consists of 3 parts, and I'll mention the first part now, which is may you live in interesting times. And if the EU economic legal framework were to be a living person, it would perfectly fit the bill, because the Eurozone and the EU is undergoing enormous changes. I think we can only compare it to the 90s, where actually the whole European Union was being set up, the Eurozone was being set up. These were historic changes. You will see everything that Taneli was talking about in history books in 10 years' time, and your kids will learn about it in classes, because it's absolutely historic changes. The giant leaps that Taneli mentioned are absolutely amazing. I have been watching it since 2005 in Brussels, when I landed from Stockholm on a Sunday evening, and on Monday I went to cover a meeting of Eurozone ministers who started changing the Stability and Growth Pact all of a sudden. So it was a bit of a shock. Anyway, the task is enormous, not least because, as you know, in the EU now there are 28 countries. The nations speak 24 different languages. In the Eurozone itself, you have 17 countries, from next year 18. And somehow you have to get not only the governments and ministers of these governments to agree with each other at meetings, but also national parliaments to have similar views. And as you know, these countries have sometimes completely different cultures, traditions. It's very difficult to explain to a German why the Greeks do something and vice versa. It's almost impossible. So the task is huge, and we'll see how it all ends. But going back to the crisis, and to the changes. Normally the European governments and institutions don't do anything unless they absolutely have to. So if there's a crisis, they will move. If there's no crisis, nothing will happen, no matter how much you need it. So in a way, the crisis that we now have is a mixed blessing. It's a disaster from an economic point of view, and people are out of jobs, and etc. It's horrible. On the other hand, it's a huge opportunity to finish a job started back in the 90s, the economic and monetary union, of which the second part, the monetary union, has happened brilliantly. We have the ECB that works, and a currency that you all use here in Belgium. The economic union, however, was slightly more problematic. Why? Because when countries have the same currency, investors, at least that used to be so for the first 10 years of the euro, investors see bonds that are sold by Greece, Germany, Finland, Austria, or Portugal, or Spain, basically as Eurozone bonds. They are denominated in euros. It's Eurozone risk. They buy Eurozone risk. They don't care what the country does because it's all euros, right? It's one central bank, one country. So that gives a perfect opportunity for various countries that don't really want to play by the rules to go crazy on spending and benefit from the fact that others are conducting very responsible and prudent monetary policies. So in the end, when you put it all into one sack, it's kind of average. The average is okay. So the Germans, being aware of that this could happen, and no points for why it was the Germans, in the mid-90s said, okay, if we are to have this union, let's have some rules as to how you can behave in such a union, economic rules that will limit the craziness that can occur if some governments are irresponsible. And this is how the Stability and Growth Pact came into being. It was later called the Stability and Growth Pact, which basically is EU budget rules. And the rules, as Taneli mentioned, set certain limits on the budget deficit and debt. They even established some steps how to punish those who break the rules. And everything seemed fine for a while, especially until the Eurozone was growing economically. The average growth back in 2000, in the first years of the last decade, was above 2%, so nobody cared about anything. And until France and Germany, the two biggest countries that actually pushed the hardest for the rules to be established, decided that they didn't like the rules because the rules turned against them. There was a time when both France and Germany had deficits above 3%. Repeatedly, the Commission tried to discipline them because the Commission's role in the EU is to guard EU law. That's what they are supposed to do, basically. So no matter what they think, they have to stand guard for EU law. And when the Commission tried to discipline France and Germany, the two countries said, oh, no, and basically blocked the disciplinary action. I don't want to go into how it was done. You would fall asleep. But generally, through very clever maneuvering, they managed to stop it. The European Court of Justice later said the Commission was right, the countries are wrong, but it was, of course, too late. The damage was done. The reputation of the pact was damaged, and smaller countries like Greece, for instance, learned the lesson that if you sign an agreement about your fiscal policy with other countries in the EU, you don't really have to sort of pay too much attention to it. It's okay, it's there, but we don't have to worry about it. To legitimize what they did, France and Germany pushed for a change in the Stability and Growth Pact in 2005 and changed it, watered down the pact, basically. It was then called making the pact more flexible, to the great amusement of journalists and economists, but that was the official version. And again, nothing bad would have happened if growth had continued, economic growth had continued, and it did for a little while. But then in 2007 and 8 and 9, you had the subprime mortgage crisis in the US, which and then Lehman Brothers collapsed, and all of a sudden Eurozone growth started going down. And in 2009, there was a recession of 4.4%, quite steep. All of a sudden, countries like Greece, which were in recession already the previous year, the recession started deepening very quickly. And after elections in October, after their elections, they came to Luxembourg for a meeting of ministers in October 2009 and announced to everybody that we know that the previous government told you that we'll have a budget deficit of 4% or something this year, but actually that's wrong, and we'll have a deficit 3 to 4 times higher than that. with a recession and a debt of 130% of GDP. When markets heard all that, they panicked. It was like, what's going on? This is really, really bad. And from then on, there are various. I mean, Greece lost market access. Taneli said what happened, how institutions scrambled to come up with a solution. It was really a matter of weeks or days that you really have to find a solution to a completely unprecedented situation. And I will sort of not go into that, but from then on, you could say that there are two points of view. Some people say that the EU always that the EU should have gotten ahead of markets, basically thrown so much money at the problem that markets would believe, would be convinced that the euro was irreversible. There was nothing would happen with it, and basically they all stand firmly behind the concept. The other school of thought, that was the Americans and that was the markets that thought that, because the Americans did the same with their subprime mortgage crisis and actually succeeded. They threw, I don't know, $700 billion at the problem, and markets sat down and listened because it was so much money that nobody dared bid against it. In Europe, where Germany as the biggest economy played the biggest role, obviously, in all negotiations. The attitude was slightly different. I'm not saying the positions were uniform, but Germany had its way in saying basically let's do as little as possible and at the very, very last second. And that's my personal view, that attitude made things much more difficult for dealing with a crisis. That's why I think it lasted as long as it did. Nevertheless, there were the EU basically did. One could generally say, I think the EU did three things to deal with the crisis. One was to create laws on a European level that made national governments cede another part of the sovereignty and economic policy making to the EU level, in order to sort of make sure that they comply with the rules. The second thing they did is to actually force governments to take seriously their own commitments and implement what they themselves have promised to do. And third was to create institutions. Institutions that were created as the famous abbreviations. It's the European Financial Stability Mechanism, European Financial Stability Facility, European Stability Mechanism, European Banking Authority. There are lots of those, but generally they were all created. Some of them actually helped calm down markets and resolve the crisis a little bit, like the two bailout funds. Although, again, because the bailout funds were always seen as too small by the markets, they were always pushing for more and more, even though more wasn't needed. But what markets wanted is sort of an absolute certainty, total conviction that no matter what happens, there will be money and they will be paid back. Now, why did they, in the first place, doubt that they would be paid back? Because until October 2010, markets, the crisis was sort of relatively, and that's a matter of opinion, but relatively subdued still. And people believed that there were constantly messages from leaders, the European Central Bank, etc. The euro is irreversible, nobody will lose any money, your investment in the euro is safe, basically. And then in October 2010, the Eurozone finance ministers met in Luxembourg to decide again in Luxembourg, by the way, to decide on changes to the Stability and Growth Pact. Basically, they were talking about how to give teeth to the EU budget rules, how to more swiftly and better punish those who break the rules, how to establish better monitoring, how to basically make people do what they were supposed to do in terms of budgetary policy. And at the same time, exactly at the same time, there was a meeting of the French President Sarkozy and German Chancellor Merkel in the port city of Deauville in France, where they were taking long walks on the beach and deciding the fate of the world, basically. So in the middle of the meeting in Luxembourg, word came from Deauville that the two leaders reached a deal, and and both countries got what they wanted. So Germany, where public opinion was quite unhappy about helping Greece, bailing it out, lending money to it. Germany got French support for its idea that in the future, if another thing like Greece should happen, private investors should share the costs. What does that mean? That basically they'll lose money. That no longer the taxpayer only will cover the costs, it will be also the bankers that bought the bonds of the country that is going under. That was the first time ever that it was publicly mentioned that private investors may lose money on an investment in a European asset, Eurozone asset. And you can of course imagine the shock wave that went through all markets as a result. The French got what they wanted. That was a watering down of the budget rules, which by now is completely insignificant. Was they got an extra step in the fine procedure. Now it seems ridiculous, but then it seemed very important for them. Anyway, as a result, because of this decision and German insistence that private investors should be involved in the future, and there was many years. It was supposed to be many years from then. Investors decided, okay, this is it. The Eurozone bonds are no longer safe. Let's look who's next in line. And next in line was Ireland. And a month later, Ireland was forced to ask for a bailout. 6 months later, Portugal was forced to ask for a bailout. Maybe I'm sort of too harsh on Germany by saying this is all the fault of this Deauville agreement, but in my opinion, it actually accelerated the crisis to a big degree at that stage. The whole idea, I mean, it was basically noble of Germany to do that, because they were trying to protect European taxpayers. It's a good thing that we, as taxpayers, do not have to pay for bailout all countries and pay investors for their folly of investing in crappy bonds. But anyway, that was what happened. The whole idea of introducing new laws as a result of the crisis, new laws at the European level, at the national level, and in new institutions, follows a very sound logic. The one I mentioned at the beginning, which was to complete the economic and monetary union, something that hasn't been done for a long time and would not probably ever happen were it not for the crisis. So it's in the end a good thing that the crisis happened from that point of view. However, all these laws and all these institutions probably would not have helped were it not for the European Central Bank, which has the greatest credibility among investors and basically has the ability to print money, although it's slightly problematic in Europe. But at least in investors' minds, that's how it is. So when things got really bad in the middle of 2012, last year, and the European leaders were slightly desperate, you could say. There was a meeting in in June, a summit at which the leaders started promising all kinds of things, the banking union among them. And it still didn't work, and still yields were going up, and Spain was at the brink of being the next country in line to go under. The then President Mario Draghi, President of the ECB, saved the day by coming out and saying, okay, that's enough. The ECB will do whatever it takes, and trust me, do whatever it takes to save the euro. Okay, so basically bugger off, and that was it. And that's all people wanted. And since then, basically the crisis has been what's the word in EU word in abeyance.
Yes.
So it's basically, it's still simmering somewhere in the background, but the markets are no longer willing to test EU policymakers because they know the ECB is there behind the whole thing, and it has a huge firepower that nobody wants to take on. So now is the time that Eurozone governments have, basically the ECB bought time for Eurozone governments to do the right thing. So now all the governments actually are trying to do the right thing, and with two steps forward, one step back. They are reforming. They are consolidating public finances. They are moving all in the right direction, and these efforts are slowly recognized. The best example, I think, is Ireland, which will finally get out of its bailout at the end of this year. It will still have to repay the money that it borrowed from the Eurozone and the IMF, but it will no longer depend on the Eurozone for its financing. It can now borrow on the market at rates that are below Spain's, below Italy's, very decent borrowing rates. So it's all moving in the right direction. But the second part of the Chinese curse I wanted to mention, I'll come back to the third at the end, which actually refers to this Deauville meeting, because the second part says, "May you come to the attention of important people," and I think unfortunately EU and Eurozone economic rules came to the attention of important people far too early, and should not have. Let me just quickly sort of list all the achievements that the EU and Eurozone has in fighting a crisis, because it's quite a bit. No matter what people say, the EU has done an enormous job in dealing with it. First of all, it set up this permanent bailout fund, the European Stability Mechanism, which is almost like there were ideas to actually name it the European Monetary Fund. In the end, I can't recall why this name did not catch on, but in the end it was called the European Stability Mechanism, and it has a lot of money, it has a lot of competence, it has now a vast array of instruments that it can use, credit lines, can intervene on primary markets, secondary markets, can lend to governments, can lend directly to banks, can recapitalize banks. It's a really major institution that has been created and is operational. It works, and I'm not sure that any other country in the world or region in the world actually has one. It's the International Monetary Fund is the only other thing that springs to mind that is comparable. But as Taneli says, it doesn't have the same money. So in this way, Europe is better. The EU budget rules that were so easily bypassed and sidestepped and ignored in the past by the big countries and small countries alike now actually have teeth. It would be very hard, probably impossible now to ignore European rules on budgets at this stage. I mean, the surveillance, the monitoring of budgetary policy is so tight, so close, through all kinds of procedures, and there's no point in enumerating them, but there's every 3 months or 2 months or 6 months, there is, the people go and look very, very closely at national budgets, what people do, how they spend money, how they plan to spend money over the next 3 or 5 years. It's the control is really, really tight. So clearly the lesson has been learned, and as Stanley said, probably public opinion in many countries will wake up later this year with a very nasty feeling that a lot of the policy making has been moved to the European level, and they will be right. There is a lot of the sovereignty has been actually moved to the European level, and it's not Brussels, because that's a misunderstanding. It's actually the European ministers meeting together and discussing things together. So it's not a single institution. It's the countries themselves. Finally, the countries have agreed, and it was one of the moments of weakness when they were trying to desperately convince investors that they actually mean business and they have learned the error of their ways and they will be better. Please believe me. And they actually signed a treaty called the Fiscal Compact Treaty, in which they agree that they will have balanced budgets, and that if you have a balanced budget, as a result, your debt will be falling. This rule of balanced budgets is supposed to be, in some countries at least, where it's possible, inscribed into the constitution. Where it's not possible, it's supposed to be sort of in as high a law as possible. So for the first time, instead of some EU law that, who cares what Brussels says, now it will be actually national law that will say you have to have a balanced budget. And if governments break their own national law, they will be responsible in front of their own national courts, and their opposition can take them to court for breaking that rule. It's a gigantic change that hasn't been there before. Public debt is supposed to be falling. There are even measures of how quickly every year it should be reduced. It's complex, so I don't want to bore you how, but theoretically, at least, governments agreed to be reducing debt by a certain amount every year. So that's another huge positive step. Because prevention is the best cure. There is a very elaborate and intrinsic system of monitoring, looking, checking, reporting, etc. that economic policy in countries has to undergo now. So with the new powers of Eurostat, basically it seems that another Greek crisis is virtually impossible. Then we have the huge step of the banking union, which is once it happens, and I know some people say if it happens, but I believe that it will happen. Things in the EU move very slowly, but they eventually happen. So eventually there will be a banking union, and once it's there, the banks will be supervised independently. So the politics of supervision will be removed, hopefully. Once banks get rid of their bad loans, and they will have to deal with them before the banking union is established, they will no longer be afraid to lend again. So there will be more money going to the economy, so businesses will get more money, so they will all employ new people. These people will have jobs, they will spend, the economy will grow, and everything will be beautiful. So basically the bottom line is, I think, of all that is that the changes in EU in the EU legal framework have been so extensive and so deep and are still going. Some of them already happened, some are ongoing, some will happen eventually. That another sort of Greek crisis is not possible, Greek-style crisis or sovereign debt crisis. However, I challenge you to show me two economic crises that are exactly the same. I mean, they're always different. So, so what awaits us? If the optimists, or maybe the visionaries or the most ambitious people in the EU believe that we will end up with a common Eurozone treasury, a Eurozone finance minister, a Eurozone budget, that the Eurozone will issue common bonds for everybody, and basically there'll be one huge integrated organism. And that brings me to the third part of the Chinese curse, which is, may your wishes be granted.
Very good. Thank you very much, Dan.
I'm not sure if the Chinese were that critical of the Commission. Sounded more like praise to me. So I don't know if you saved a couple of criticisms up your sleeve. But if not Jan, it's definitely the turn now for you to pose your difficult questions to both of our speakers. So let's start from the back there.
I'd actually like to continue where the latter speaker ended about banks. You said that the Eurozone and the European Union usually push forward during crisis, and now when we're getting through a crisis, do you still think we have enough momentum politically to go through the whole banking union? Whereas we have, if I know right, put down 2 banks during the whole economic crisis in Europe, and in US it's about 160 or at least about 100 banks.
Let's maybe collect a couple of questions first. Yes.
By joining the fiscal union, most of the countries lose one of their main instruments for governing the country's economy. That's the fiscal policy. And they transfer those rights to the central bank. Do you think that then the European countries lose competitiveness because we tackle the crisis standing on one leg? It's like a football game where we just have one leg. Where, because the European Central Bank only cares, or main priority has for price stability. So it's more or less pro-cycle policy that they have, where, as we have seen in other countries, they tackle the crisis on both bases. And just on that base, an additional question: do you think that the countries who are EU members but outside of the monetary union tackle the crisis had an easier time tackling the crisis?
Very good. Two good questions. Should we go in the same order, or would you Taneli like to answer them first?
Yeah, I can try first, yes. Thank you very much. On the banking union, I think it is, and on the whole integration process, and any next step in terms of integration, and it will indeed probably be more difficult for member states, governments to accept what is necessary. I think on the banking union, in principle, the governments have already agreed to the main elements in general terms, and now it is about finalizing the legislation. And basically, on the single supervisor, the legislation has already been approved, and the supervisor will be established and will take office and will start functioning somewhere end of next year. But on the resolution mechanism, which implies also some financial contributions by member states or by the industry rather to a common resolution fund, their decisions are still to be taken, and there is no full agreement yet about the final design of the resolution mechanism and all that comes with it. But I think there's still enough market pressure there probably to keep the member states moving forward, and I think the markets are pretty alert about developments in Europe. If things start going wrong, and if the reform momentum gives up, I think it won't take more than a couple of weeks, and then all of a sudden interest rates start increasing again, and that will again help focus minds. But I think there's also more to it than that. I think there's also a broader, deeper recognition of the need to actually move forward and complete these elements. It's not just because of market pressure that governments have agreed to significant commitments. It is more also a whole. It is a more fundamental process that governments, decision makers have gone through over the past 2-3 years, and they realize that this is necessary. So on the banking union, I think we will be okay, as Jan was saying as well, and it will be established. Question will then be, question will then be more about these other elements that also Jan was referring to, and whether we will actually move towards a full fiscal union with a real budget for the euro area, with the fiscal capacity, with the treasury and so forth. That I don't know. And but that's also something that cannot be built because of market pressure. It will have to be because of more sort of thorough and fundamental considerations that are also involving the broader population, and it's not just governments and ministers who can do it, and it will have to be a broader European policy process. On the role of the ECB and the mandate of the ECB, that member states have given monetary policy to the ECB. That means that adjustment to economic crisis and will have to be done by other means than monetary policy, by exchange rate policies, for example. But that also means that the adjustment is then more real and more sustainable. And devaluations, competitive devaluations, have never led to anything good in the medium term, and they can help in the very short term, but it always comes with a very high cost for the medium and long term, and this is behind the whole idea of the monetary union. That these competitive exchange rate policies that also Europe has had its share of, that we stop with that, because the social cost of that were very high. Now, and if we look at countries like the UK outside the monetary union, or perhaps even the US, where the role of the central bank is a bit different from ours, or Japan, where also and the central bank has been given a task to pursue expansionary monetary policies in order to stimulate growth, it seems to function, but I think there is still a question about what will be the medium to long-term impact of that, because expansionary monetary policy tends to turn into high inflation at some point, exactly. and also into asset bubbles. And again, I mean, then and in the UK, and one can perhaps already see some elements of yet another housing bubble emerging because of the excess liquidity in the economy. And that, in the short term, it may look like growth, and in the short term, everybody might be happy for a while, but it tends to burst, and then it comes with a very high cost. So I really believe that sort of monetary stimulus can work for a short while, and the ECB has, in fact, done its share of it. But I mean, it cannot replace more fundamental reforms to economic structures.
Jan, you want to comment as well?
Very quickly, I mean, the momentum for the banking union, it does seem that it's weakening from my perspective as an outsider. Taneli knows because he sits in the meetings, so he knows best. But from at least some progress had been stalled by the fact that everybody was waiting for the outcome of the German elections. As you know, Germany is the biggest economy. They do have the most money. They do have banks that they cherish a lot, especially the Sparkassen, which are local banks and very closely tied to local politicians. And these local politicians do not really want to see these banks being moved under the supervision of the ECB and completely severing their ties. So there is an element of self-interest here, and I mean, that's the way it is. We might not like it, but that's the way it is. So, so in a way, some sort of compromise probably will be worked out in terms of which banks will be supervised directly by the ECB, which not, and so on. But in the end, it will happen. So it's too big a deal, and things have gone too far to just abandon the idea and say, oh no, forget it. It's no longer valid. It will happen.
Can I ask you on that one? Just what about people, the voters? I mean, you talk about the governments, but I mean, is the German election result a confirmation that the people will also follow the treat, or is that, and I mean, are they also, do they share this feeling that we are too far in, you know,
Well,
do they think
clearly,
it's the
the sort of relatively cautious policies of Angela Merkel have won her great support. So hats off. I mean, for in terms of, you know, as a politician, she's extremely effective, and that's basically what counts in politics. So,
But what about the other countries? Are they equally effective? Are they equally?
we'll see. We'll see about that. I'm pretty sure that, I mean, you know, Merkel is very pro-European. So I don't think we have anything to worry about in the end. You don't want to antagonize the electorate just before the elections with sort of huge controversial decisions, which is again part of the tactics normally employed by politicians. So I'm pretty sure that things will move on. But just to come back to your question for a second on the competitiveness, which you wouldn't believe how often this word is repeated in EU circles. Competitiveness is basically all people now think about, and rightly so. But in fact, the EU, even though there's a lot of hot air and a lot of empty talk about this, the EU has done something concrete, and it's another pact that the leaders agreed to. It's called the Euro Plus Pact, which is all about competitiveness, and was done back in 2011, I think, again to impress markets. It did not impress markets, but it actually talks about raising the retirement age in various countries. It talks about abolishing wage indexation, something not very popular here in Belgium, but actually quite important when you have to compete in terms of unit labor costs globally. And they talked a lot about investment in research, science, education, universities, etc. So there is supposed to be 3% of GDP was supposed to be invested in research according to the pact. So it's there are actually things that the leaders had agreed to. Now that I think about it, I'll have to go back and check how people are delivering on these promises. They probably aren't. But the EU has done things to do that. And but you're right that once monetary policy is taken out of the equation, you're left with very, very painful measures, like in Greece, where I think wages had to go down 30%, 40%, in order to regain competitiveness. And the same thing happened in Portugal. Even how did others outside the Eurozone fare? I mean, that's a good question, because we had the example of Latvia, which is a sort of semi-outside, semi-inside the Eurozone, because they pegged their Lat currency to the euro back in 2000 or something. It's very early days, and no matter what, and they went through a horrible crisis, much worse than their Greek one, because it's a tiny country, nobody cares, so nobody listens. But they went through actually an absolutely horrible crisis a few years back. They borrowed money from the IMF and the EU to help them stabilize, and they did not abandon the euro peg. So they did not devalue their currency, even though that was the simplest way out. Instead, they cut wages, and if you ever do any research on it, you'll see stories, hero stories actually, of people deciding in local communities they will take a 30% pay cut or 40% pay cut just to keep their jobs and to keep on going. So, and now Latvia is a Baltic tiger, and they are supposed to enter the Eurozone from next year. So it's very it's very encouraging. Poland, my home country, did the other thing. They used the exchange rate to cushion the economic downturn very successfully, and admittedly, part of the Polish success story is thanks to EU funds, gigantic amounts of money that are being pumped into Poland, billions of euros from the budget, but they are used well. Similar amounts of money were pumped into Greece, and look what happened. So they were used well, and so the country is growing. But they did use the exchange rate to adjust and cushion the blow, and so various approaches are possible, and it all depends on basically what kind of sacrifice are you willing to make, and yeah, that's it.
Very good. We have time for a couple more questions. So let's take 1, 2, and 3. Let's have ladies first.
Don't you think that the preferred creditor status of the ESM will prevent the interest rates on the government bonds of the countries with an ESM rescue package to return to reasonable levels? Because actually this was the case with the rescue package to the Spanish banking sector. Because of the preferred creditor status of the ESM, we saw a rise in the interest rates on the government bonds of Spain, and therefore it was switched to the ESM, I think. So maybe, I don't know, maybe it's a problem, the preferred creditor status of the ESM. What do you think about this?
Just to say, I'm impressed with the level of knowledge.
Yes, me too. That is impressive. Yes. I don't think that we changed with Spain from ESM to EFSM, but there were indeed concerns about how other investors would treat the fact that they would be in hierarchy below the ESM, because so far there's been only one lender internationally who has a preferred creditor status, and that is the IMF. And the ESM was then made, it was simply announced that the ESM will have a close to similar status, only next to the IMF. But there was some nervousness when this feature was introduced to the ESM, and when the first ESM programs and loans were dispersed. But I think, and this issue has pretty much disappeared, in fact, and also in the Spanish rates, and they have come down quite quickly. And since beginning of this year, in fact, and Spain has had quite a good access to financial market, despite these ESM loans that it has received. I think there are these things that seem very big at a given moment, and this was very big, and when the ESM was formed. And just like Jan was saying, and there was this one little thing in the six-pack that was so important that the French president had to negotiate something about that with the German chancellor. 2 years later, nobody really cares or remembers, and it's difficult to in advance to figure out and what actually is going to trigger a wider impact and a chain of events and what not. But the preferred creditor status is not really an issue, not at the moment at least.
But you're right that it was.
It was. Yes.
It was.
Yes. Yes.
Very good. I think the second question was in the middle.
A lot of optimism actually about changes, so that everything will be working on making everything more competitive, and then we have stabilized everything at the European level. But doesn't it look like the smallest common denominator of all European possible policies, in the sense that, okay, you agree to do the minimum, price stability by the ECB and competitiveness in the long term by European countries, but there's nothing more about doing macroeconomic management. And related to that, that actually in the future create a new crisis. There's even hinted to be discontent happening at national level because of the lack of macroeconomic management. Say not the use of fiscal policy is completely constrained, whereas there may be other constraints that can be
If you refer to macroeconomic demand management and whether that should be something to be done and considered at euro area level. Personally, I'm not a great believer in demand management and its impact, sustainable impact on economic growth. But there are others smarter than me who believe strongly in its merits. But at the moment, we don't really have the means, we don't have the instruments, the treaties would not allow it, and then I think, and here we arrive to the questions of democratic legitimacy and political integration. I think before demand management, meaning that there would be transfers of wealth from one part of Europe to another part of Europe in order to equal out demand differences or the differences in cycle. That would require quite a lot of acceptance by the European citizens of that. And before there are mechanisms whereby, or before actually European citizens feel ownership of the euro area and that they feel that they can actually have an impact on the decisions on whether there will be, for example, active demand management or not, I don't think it can really happen, and it is in any case, I mean, not really something for now, but it is. And we issued a year ago a paper that is called a blueprint for a deep and genuine economic and monetary union, and there we touch upon this issue as one of the elements to be considered for the longer term, following deeper integration in political, fiscal, economic policy terms. And once we get there, yes, I mean, then we should discuss it. But it's not really something for now, and we simply don't. And imagine going with the request now to one half of the member states and say that, well, look, your wealth levels are such that we think you should give away some of that and give that to another half of the European Union. I think that probably would be the end of the Union at the moment. It's just the political reality.
Jan, will you add to that?
No, there's no comment.
No comment. Very good. Mark.
Thank you. Well, firstly, thank you both very much. It was fascinating to hear everything. On the fiscal compact, to what extent is it weakened? Two questions to both of you. To what extent do you think it's weakened by being outside the normal framework of union law? And because, of course, the Brits refused to endorse it. And secondly, looking ahead on the same theme, if the UK does fall out of the Union, will that make it easier for us to organise our financial and economic affairs in the future together?
From the Commission point of view, the fiscal compact was, it was not something that we were strongly promoting, and we didn't really consider it that necessary. We still don't think it is absolutely necessary, because most of the elements of the fiscal compact we had just introduced into EU law with the six-pack at the time when the fiscal compact was agreed. There were only 2-3 small elements in the fiscal compact that were not yet EU law, and then we introduced into EU law with the two-pack half a year later or so, or even faster. It was when we made the proposal a month after the fiscal compact had been agreed. So, and what it does is that and we have EU law, and then with the fiscal compact, member states actually agreed that fine, they will turn that EU law into national law as well. From our point of view, that was never really necessary, because EU law has is above national law. But fine, I mean, it doesn't harm. And of course, I mean, since the balanced budgets are now in most member states' constitutions or at a similar level, maybe it helps. It makes our job, in some ways, it should make our job a bit easier. But let's see. For the UK, I mean, if UK was outside of the Union, if it would make the life of UK easier, if it could.
Life of us.
EU,
of the EU.
Yeah, don't be confused by my accent.
Okay. No. I think. Well, the UK has not really blocked any progress yet in any field that has been necessary for the euro area in terms of deeper integration. They've not had they've never used really veto right at any critical point. In fact, it was the UK Minister George Osborne who first said that it is in the remorseless logic of the economic and monetary union that you have to move towards a full political, fiscal, economic union. Something like that. But it was the remorseless logic. I mean, and he sees it clearly, but he just doesn't want his country to be part of it. But for us, I mean, the UK, it's a large economy. It is in some ways, to many of our companies and to Europe, it provides a window to large parts of the world. It is a financial center that cannot be easily replaced with anything else. It would be a great loss for Europe and European people if the UK decided to leave. But it is a difficult relation, yes. And that...
I don't have much to add. The whole idea of the compact was it had to be a. I mean, the fact that it was a treaty was generally the difference. I'm not sure how you are of how it works, but if a law is a so-called community law, which is EU law, it means it can protect equally well the small and the big, the weak and the powerful, and the Commission stands sort of as the guardian of the execution of that law, etc. If it's an intergovernmental treaty, it's just a deal between governments. That's it. It's nobody can do anything about it, right? So of course, it's from the point of view of Europe as a united organism, it's much better to have law that is EU law, community law, that is agreed by all members, right? However, Britain has been using this as a bargaining chip for quite a while, and that's why, for instance, treaty change now that Germany demands to complete the banking union is such a abhorrent idea to many politicians, because they know that as soon as they reopen treaty negotiations, the UK will demand lots of things in exchange for its acceptance of changes to the treaty. So in a way, Britain is not playing fair in that sense. But on the other hand, come on, it's politics. I mean, this is how you do deals. It's you have to have leverage. You push. It's the way the world works. So I'm sure Britain outside the EU and its economic policy would suffer, because it's probably few people know that the biggest trading partner of Britain is the Eurozone. It's the biggest trading partner. So so Britain actually joined the EU because of the trade ties, only because of the trade ties. It never wanted anything else, and still doesn't. But obviously the political clout that Britain carries on the world stage, all the other benefits that come from a single market, this is something that makes it worthwhile for Britain to be together with the EU.
Yeah, if I can add still to that, I think there's in the UK domestic debate, and there's sort of an image that has been created that it would be so nice and just to have a free trade agreement. I mean, just free trade, the single market, but no EU rules and regulations, no EU institutions. Just enjoy the benefits, but no obligations. But for the single market to function, you need EU rules, and this is the reason for there to be EU rules and regulations. And if you have EU legislation, then there need to be institutions who are actually developing it, legislating and implementing it. So it doesn't really function without the EU institutions. So a single market without rules and regulations and institutions is simply an illusion. It doesn't exist. And of course, I mean, all this talk about these huge EU bureaucracies, I mean, it's just, it's sorry to say it so bluntly, but it's nonsense. The EU institutions employ less people than the city of Antwerp. And of course, and it is not directly comparable, but still, I mean, this is not a huge bureaucracy that we have in Brussels. This is a relatively small and lean bureaucracy for the kind of job that we are doing. A single market of 500 million people, of 28 member states. It does require, at the minimum, institutional capacity to run, and that's, I think, what we have at the moment. Also, and when I listen sometimes to international investors, especially from outside Europe, and when I ask them if they consider EU laws and EU regulations an obstacle for their investment in Europe, or as a competitiveness harming component, they say, no, it's not EU rules, they are good, but it's the 28 interpretations of those rules. That's what causes a problem, and that is why the single market is not really a single market. So some Chinese ones, they said that they wanted to build a factory for the single market because they had heard that in the European Union you have 500 million wealthy consumers. They wanted to produce something for them. They came for a study tour of a month in Europe, and then at the end of the tour they came and saw me and they said that, yeah, well, we are really disappointed. We would like to invest in Europe, but we find out that we have to invest in 28 member states. So we are not going to invest at all. This is what harms our competitiveness and wealth, not EU rules. And of course there are bad EU rules. There's bad national legislation as well. But I still think that it is more the diversity of legislation and the implementation of EU laws that causes more harm than even our silly rules sometimes.
Yeah, just speak on that part, because one of the things you mentioned earlier on, quite interesting, was that sometimes there's a perception that the Commission is too disciplined, while you were at the same time also saying that it was in a way the rulelessness of not applying the rules properly that was creating the problems.
Yes.
So there is also the side to the implementation. There is no law as long as the law is not applied.
Exactly.
There's also that aspect to the notion of law and rules that is also vital in a way to keep in mind.
That's why the Commission very often annoys national governments, because it tells them to do things and the governments hate it.
Yes.
Yeah. Very good. We have maybe time for a couple of more questions. Any interested ones? Carla in the middle, and then anybody else? Still, Marx has another question. So go ahead.
Yeah, I have a rather simple question. Namely, what are the sanctions now, the concrete sanctions, and how far do these keep better than the ones we had before? And for example, was the option to withdraw a country from the monetary union, which is not economically able to fulfill the duties of the monetary union, an idea or a model which was discussed in this sanction.
Okay. On the sanctions and what we introduced for the fiscal side, and we have a mechanism whereby if a member state is, say, this is a bit complicated, this will take 5 minutes, but I'll try. If a member state has a balanced budget, everything is fine. If it is departing from that balanced budget for no good reason, then under some circumstances we can force the member state to deposit 0.2% of their GDP in an EU account. It will get an interest payment for that, but the money will be kept in an EU account until it has again returned to the situation where it's supposed to be, the fiscal situation. If the member state then breaches the 3% deficit hurdle, it goes into what is called an excessive deficit procedure. And at that stage, the deposit becomes non-interest bearing. So the member state will start making a loss on its deposit. If it doesn't correct the excessive deficit according to the recommendations that have been given to the member state, then every 3 months there will be a fine of 0.2% of GDP. And that will quickly turn so expensive that I think many member states will choose rather to fix the budget than pay them. It is very concrete, and we have. I mean, now of course, I mean, well, when we started, I said 24 out of 27 member states back then were in excessive deficit procedure. So we didn't impose a fine immediately on everybody, but it was agreed that that in case they don't comply with the recommendations to correct their excessive deficit, then there will be a fine. And there have been a couple of moments with a couple of member states and where they have tested our ability and will to actually enforce this. I remember there was one New Year's Eve. I had hoped for holidays, but I didn't have any because a country was about to adopt a budget for the following day. That would have meant a deficit that was a little bit higher than had been recommended. And then in that night, on that New Year's night, I mean, we produced a Commission decision which would have put an 800 million fine to that member state. And we said that we will adopt this on a New Year's Day unless there is a correction. And then over that night there was the correction. I mean, the couple of percentage points, although the 0.2 percentage points were found.
You sure it was not Christmas?
Sure, it was not Christmas. That was New Year, I remember too well. Yes.
No presents. The reverse. Want to comment on that as well?
No, it's, that's the best story I've heard, actually. I'll try to guess which country that was. I have my suspicions.
Very good.
I want you to make it more clear because according to the treaties of European Union, so there's just a provision that the member state volunteered to withdraw from the union, whether they had to be compulsory getting out of the union, or which is the legal ground for that possibility that you just say. The first step is a financial sanction, but the second step, whether it's a compulsory getting out of the union, and this is a legal.
No, that is not possible according to the treaties. No, and I think that would. I mean, if there was a possibility that a member state would be excluded from the Economic and Monetary Union, and that would then mean that the Economic and Monetary Union is not really a union, and it is not a permanent fundamental union, and it's just a club that you join and you leave, and that's not how you can actually run a union that we are supposed to run. Also, the treaties have a provision since the Lisbon Treaty entered into force that a member state can leave the union if it so wishes. But there's no way for other member states to actually push someone out, thank God, because I think that would be...
Although we have to recognize where the questions are coming from, because it's there was a discussion about Greece back in, what was it, late December 2011, I think, when the Prime Minister then, Mr. Papandreou, was given a stark choice. I mean, he came up with the idea of a referendum on the reforms, which was basically, in the end, a referendum on the euro, and it was never sort of said officially, but unofficially, everybody knew that the German Chancellor and the French President and others basically said, well, you know, if you don't like it, just get out. So. There was a very brief flirtation with the idea that Greece could be kicked out, but nobody really wanted it. It was just because Greece was being so difficult that the other countries were up against the wall. Basically, it was, you know, how do you force these people to do what they are supposed to instead of just taking our money, you know?
Yeah. For us, I mean, this was of course, and we never wanted to accept that a member state is put in front of such a choice, because for us the integrity of the union is absolutely crucial. Member states cannot be pushed out, because if that was possible, then there would be no end to it. And the integrity has to be guaranteed. So if someone leaves, then voluntarily, but not pushed by others.
Good. Max, one more final question.
I'll try to help you to save time already by doing some of your work in my question. We talked today about the developments toward completing the economic and monetary union. And as you may or may not know, in the upcoming sessions, we'll focus on different fields of law and the crisis in different fields of law, starting next Wednesday. So Dr. Lahti already mentioned that the engine of the growth is the single market and it must be completed. Now drawing on that, do you think that the crisis and the development that has come now in the field of the monetary union, has that facilitated or made it more difficult to make progress in other fields such as the single market and completing the single market?
I think the search for growth and sort of growth areas and growth engines has helped bring forward also some progress in the single market area. And then also many of the problems of the single market are because uncompleted reforms in member states, labor market or otherwise product services markets, and by pushing forward those national reforms, we are effectively also pushing forward the single market. But there is still a lot to be done in that field. But this is the main asset we have. I mean, this is why we still matter in the world, and this is why, for example, well, at the deepest moment of the crisis, it was the Chinese and the Americans who started calling us every day, asking that now try to get your act together because our growth depends on you guys. And they were really nervous. And I remember the Chinese minister coming several times over to say that now look, if EU growth really doesn't pick up soon, then the Chinese growth will slow down quickly, and that will quickly cause risks to the social and political cohesion of China. So, and Chinese growth and well-being and future depends very much on how the European economy functions. Same applies also to the US, and of course vice versa. I mean, we depend very much on how they function. And if you allow still a final sort of appeal from me, I mean, for Europe. I think one thing that we now often forget in the domestic and national debates in Europe and we lose a bit of perspective. And from the outside, our case looks much clearer than from the inside, and we quarrel and fight amongst each other and how far to integrate and so forth. But from the outside, and they just get that, well, why don't you act like the European Union you claim to be? And this is for the future of you and your children, and this is utmost important, because I genuinely believe that choices and policies and decisions that have a direct impact on people's lives and futures and opportunities, they are taken at local level, they are taken at regional level, and they are taken at global level. And at the global level, there is no single member state anymore that can actually, in a couple of years from now, really have an impact in the G20 or wherever decisions and choices are made. But the EU as one still continues to matter for decades to come. But this will require that the EU really starts to act as the union, and will also be represented externally as a union and not as a bunch of 28.
I think that's a very nice move to the single market discussions next week, Wednesday. So I would just like to thank both speakers, and indeed, like Max already nicely did, remind you that next week it's not Tuesday but Wednesday night, and we will be then at the IS playing around 5-1. We have with us Jonathan Fall, Director General, and we have Mr. Giegold, German MEP, also very big figure in the internal market debate. So we will continue on the same very high level as our speakers tonight. So thanks once more, gentlemen, for coming.